Hello and welcome to Big Deal. And while we are still digesting the budget announcements, let's focus on certain fine print details set to impact the fundraising as well as M&A deal action on the street. Let me welcome on the show Ashok Wadhwa of Ambit and Amrish Shah from Deloitte, India, to throw more light on that. Welcome to CNBC-TV18, gentlemen. Ashok, first coming to you, what is, in your view, are the biggest takeaways when it comes to spurring investments as well as M&A from the budget proposals? Ashok, can you hear me? All right. Let me take that question across to Amrish while we fix that audio glitch with Ashok. So, Amrish, what are the biggest takeaways for you?
Nisha, so I think the biggest takeaways are, the infra push, if one has to look at it. I think the credit that they have given to the MSME and SME, which will generate demand and therefore, again, look at better output and productivity on an overall basis, which means there will be more deals even in those spaces as we will see them. I think as we've seen in the last 1 year, record fundraise on the capital markets, and that's going to keep on expanding to my mind. And I think the unicorns will be many more this year as, we are bolstering the startup system, because that's what was something which was mentioned in the budget speech also. But I think the biggest thing is, the capital expenditure, which will, revive the overall economy.
Right. So, Ashok, to my question then, biggest takeaways from you when it comes to more spurring M&A and also boosting investments from the budget?
I didn't hear the last part of what Amrish said, but I presume he was talking about government's significantly larger expenditure to revive capital expenditure, in particular investment in infrastructure. And I think that's perhaps the one area where India has seen a lot of capital flows from overseas, both in the form of InvITs as well as in form of both private equity and strategic investment. And I would like to believe that revival of the capital cycle, the expansion of capacity, whether as a result of PLI or indeed investment in new infrastructure projects, I think all these are wonderful opportunities where there's going to be a lot of foreign capital, new capital that will come in. Government, as you know, has expanded the definition of infrastructure to include both storage facilities, in particular very relevant in the era of green energy, and data centers. Yes. And I'd like to believe that by including these two very important futuristic asset categories in the definition of infrastructure, government has invited a lot more foreign capital, particularly from long-term investors like insurance companies, pension funds, and sovereign funds. So I would believe that infrastructure certainly is going to be a huge beneficiary of new capital flows and of M&A activity.
That's right, well pointed out. And data centers, as we know, is a lifeline of the digital thrust that we are seeing, and it's a very important recognition given to them. Now, Amrish, talking about the specifics, government has been working on simplifying, especially the dividend taxation over the years. And now, again, they have come up with certain more provisions which simplifies it further. And tax efficiency, remember, from the dividend perspective, is also very important for any movement in a company and the decision making as well. So what stands out on that?
So I think the one or two changes that they have made, one is around, dividends that were received from foreign entities by our Indian holding companies, which was, subject to a 15% tax rate. In the new dividend regime, if those holding companies are in turn returning the dividends, the exemption was already available. So, I think it's a welcome step. You get dividends from your subsidiaries, then, if you get it back, anyway, you were exempt. So that's one thing that is going to have see the sunset on March 31st this year. I think the second, which I think they've just expanded the asset category. There is always, this issue around bonus strippings and dividend strippings, where you buy shares, get a bonus, and you try to sell the shares and claim a capital loss. Those losses are not allowed. Now, they've covered units of InvITs, REITs, and AIF as part of that. So I think they're clubbing, all the investment assets into a similar category. And I think that's the right move in that sense.
That's right. So a lot of changes, and also InvITs and REITs are evolving again and again, and that's very important for infrastructure funding. Ashok, you mentioned that. But when it comes to more avenues for funding the infrastructure projects, how are we developing? Of course, fund of funds is also something that the government is focusing on now very closely, where the government may have only 20% of control, and then the rest can be managed by a professionally managed fund, and therefore there can be a pooled capital which can be focused towards infrastructure. What more can be done?
I think in many ways, when it comes to funding infrastructure, Government of India has actually led from the front, whether it was in the conceptualization and then the implementation of InvITs and REITs. The demand from the industry was there for a while. Hello?
Yes, go on.
Yeah, the demand from the industry was there for a while, but introducing those important legislations, first for the benefit of private sector to be able to recycle the capital, and then, of course, now for the public sector. Remember, two of the larger divestment programs last year was the InvIT for Power Grid and for NHAI. And if you look at the demand that came from global investors, both at the anchor level and then in the participation, it goes to reflect the fact that these are very attractive vehicles for recycling capital from Government of India's perspective. I think Government of India, like private sector, now recognizes that conceptualizing and developing projects is perhaps part of either government's domain or private sector, or maybe PPP, and then selling these completed assets down to InvITs in case of the government has been a wonderful mechanism to recycle assets. I believe there are more opportunities. GAIL could be the next one. Given the amount of power projects and power generation that the government does, that could be the next one. At some stage, distribution of electricity could be the next one.
That's right.
These are all avenues that are capital starved, that can absorb a lot more capital.
Yes.
And I think there is enough and more long-term capital wanting to be invested in these opportunities.
That's right. Well pointed out, Ashok. In fact, this investment is going to be the key area which could see a lot of action going forward. And government has also got a much more reasonable target for this particular year as well. Well pointed out. And there is one change that is made in budget proposals, which Amrish can throw more light on the carry forward of losses. How will this really change the game for the future buyers and the investors, or in these PSU disinvestment trusts that we are going to see, Amrish?
So, Nisha, I think this is an important change from the buyer's perspective, because they will now be able to actually value, because this carry forward of losses for PSU is now allowed. So they will be actually able to value those losses, and the government will be able to get a better price on the disinvestment. And I think this is a really good welcome change, and it helps to monetize, the government assets in a better way. This losses, so long as the only condition that they have put is that the new buyer should keep on owning 51% of the assets till the losses are utilized. So I think that's the good way to, give the benefit to the new buyer and allow them, the benefit of the tax.
Right, and one more change on the TDS on immovable property. What is the kind of impact on real estate of that, Amrish?
So I think, this is something which I think is an issue from a real estate deal perspective, because today what the government has done over the last few years is to say that, you either pay tax on basis of consideration that you have, got, or the stamp duty value. They had also provided for a safe harbor of 20%, to the stamp duty reckoner values that we have. Whereas this TDS provision says that it is higher of the consideration or the stamp duty value. So the safe harbor for the TDS is not available. So I think there will be a lot of, representations to the government on this to at least connect it to that safe harbor part. I think that's something that will have to be looked in. Otherwise, there will be a cash flow issues in the deals, and that's something that we'll have to live with if it is not done.
Right. Ashok, coming to you on this one, an important subset of the overall infrastructure game is real estate. And government has done enough overall with RERA coming in and many changes. And this time the budget spoke about even the land records and more centralized digital land records there. How is that going to change the game when it comes to the real estate sector?
From, say, about 10 years ago, when we were in what I would call wonderful West, using that parlance for the real estate industry at that point of time, to today, of course, post-RERA, which created the first real framework regulating real estate, and now towards addressing one of the more important issues related to land ownership, the process of digitization. I think we've come a long, long, long way. The industry, from being a relatively informal industry, has now been formalized and in my view, is guided by the same factors of governance and transparency as any other industry. And we know that well-governed companies, good and clean companies, as we call them in Ambit parlance, are very important characteristics for attracting both domestic as well as global capital. It's my belief, therefore, that real estate in its current avatar has a significant opportunity. It went through a bit of a difficult period at one point of time when there was oversupply and prices had really, largely because of speculation, moved significantly upwards. And I think that led to a situation where between excessive borrowings by the developers on one side and inability to reduce prices to make it more realistic from a customer's perspective, resulted in huge carry forward of inventory and some defaults within the banking sector. But I think where we are today, post-COVID, is partly because of much of this inventory having already been sold out. And we know, I mean, numbers for January 2022, stamp duty collected on sale of property, real estate, was the single highest month ever reported in the state of Maharashtra. So it's my belief that the historical inventory has been cleared out. And we now have a new era where working from home is leading to new and aspirational requirements for many, many professionals and many, many employees. The demand for housing is back. Funding of housing by NBFCs and housing companies is very much available today. And our belief is that going forward, real estate is going to be one of the large beneficiaries of both new capital as well as this more formalized environment. So we remain bullish on the real estate industry going forward from here.
That's right. Very well put, Ashok, on that very point. And real estate, remember, is central to any country when it comes to, giving the housing to the people. And on the other hand, also land title, which has been a big issue, is in some ways addressed at this point to attract more investments and have more comfort for the foreign investors to put in money in real estate space. Hold your thoughts there, gentlemen. We'll take a quick break and we'll come back to discuss more about the fine print of the budget and how it impacts the deal streets. Stay tuned. Welcome back. You're watching Big Deal and we are discussing and decoding the budget, union budget, and how it impacts M&A going forward. Ashok, one space which has seen heightened amount of M&A as well as fundraising has been the digital space, the internet space, the new age companies and the startups. How do you see that developing? Because of two important reasons. One, the LTCG surcharge to some extent is moving towards parity, which has been the long-standing demand by the industry. And the second, which is not particular to budget, but we have seen a slew of IPOs already, and post-listing, they're going down below their IPO price. Now, how do these two things fit in together to define the future course of fundraising as well as M&A here and the valuations?
So, Nisha, the fundamental principles that were guiding traction of capital for these opportunities in India still remain very intact. Young entrepreneurs willing to take the risk, people with very bright ideas, high intellectual capability, and then access to capital that wants to back these ideas, because honestly, post-developments in China, India has become a very attractive destination for this capital. So the fundamental principles on the basis of which this industry has flourished in India continues to remain intact. Sure, some of the public offerings have not been as successful in terms of post-listing price and where the valuation stands today, where these companies got listed. But that's par for the course. We have to accept the fact that some of the tailwind that helped the markets to move so aggressively upwards perhaps will be missing in the next 12 months. I'm not suggesting that they will convert into headwinds, but perhaps the tailwinds will get diluted and therefore the momentum will be perhaps a little slower. But the fundamental principles on which that capital was attracted continues to remain intact. And therefore it's my belief that these companies and these young entrepreneurs will continue to attract large doses of capital. I actually see an interesting change coming because of these tailwinds diluting in the marketplace. I actually see these companies that have access to a lot of capital and that have been built on strong governing principles now becoming acquirers to many offline companies. Because eventually, remember, there is no such concept as online versus offline. I think eventually you will see those who have access to capital, those who have built strong businesses on good business principles, and many of these unicorns have, will become acquirers of older generation offline companies. And the combination between the two will provide what the market eventually wants: scale, ability to grow, and get sustainable, stable cash flows with proven EBITDA earnings. So I see a lot new opportunity in the acquisition of these online companies of offline assets in India, and that consolidation play out. And I think that consolidation will continue to receive huge amount of support from investors and markets. And I don't see a dearth of capital to support these acquisitions and these opportunities going forward. No doubt that reduction in capital gains tax is positive, but I really wish that government could have extended the 2-year unlisted to 3 years, but brought the tax rates down. There's no reason why an individual has to pay 40-45% on short-term capital gains if an investment through a holding company was to attract 25%. So I wish there was a little more alignment and the short-term capital gains tax on some of these opportunities was brought down, but I'm sure at some point of time that alignment will happen.
So the government is actually, the industry has seen this move by the government to cap the LTCG surcharge at 15% as a move in the good direction, actually, Ashok. So let's hope that by the next year, probably there is some semblance of that parity between public and private market. But Amrish is back with us. Amrish, IBC. All right, we'll get back to Amrish. But Ashok, one more important aspect on the valuations, because you are a very close market watcher as well. What is a lesson from the way we have seen the IPO frenzy and where it stands currently?
Well, it goes to say the same thing that we have heard repeatedly, but we tend to forget it from time to time, which is that market moves on sentiments, market moves on liquidity, and of course, market moves on fundamentals. You take away some of these factors from time to time, you will land back to fundamentals are eventually the drivers of long-term value in any market proposition. And we learned over the last few months, perhaps a couple of years, that growth is a very important driver for valuations in the market. We all grew up learning that cash flows and sustainable cash flows and sustainable profitability were the sole drivers. But the one change that we have all come to accept is that growth has become a very important factor in determining future prospects of any company and its valuation. And therefore, any company that is able to demonstrate potential for growing consistently, and of course, if it can then marry profitability and sustainability of cash flows, I think that's the true winner in the marketplace. So when all these sentiments and all this easy money and benign liquidity scenario kind of is withdrawn and there is normalcy in the marketplace, we will come back to saying that the old principles of EBITDA, sustainability of cash flows, free cash flows, of course, aided and supported now by a huge growth curve.
So I'll pick on that word, sustainability of valuations as much required at this time, and probably that sanity is coming in. But my final question to Amrish. Amrish, of course, IBC cases have driven a large part of action when it comes to M&A. Now, how do you see some of the changes which have been brought about, small but very important ones, and especially to amend the IBC to facilitate cross-border insolvency cases? How are these going to impact the IBC cases going forward?
Yeah, I think it's an important change here, a vision that the government has put when, they've talked about cross-border IBC cases to be covered, as part of the IBC framework. I think if you look at the IBC, that is one law which has helped a lot in terms of the changes. It's gone step by step. We had, the companies in India covered, and then we moved it a little further, with all the learnings that we've had, and the government has been fast to incorporate those learnings in the act. And now, to go and look at it from a cross-border perspective. But the one more important change that they've done in the tax law, which is a very good thing. Today, under the IBC Act, any government dues on the income tax side is equivalent to any unsecured creditor. So they have the same weightage. And if you have a haircut that is announced, by the authority, which is the NCLT, what used to happen is the tax officers used to challenge that, and used to go for their full demand. I think the law now requires them to accept whatever has been said by the NCLT, and that will be a big boost for the new buyers in IBC cases who are more concerned with revival of the companies, rather than fighting some case, on the tax side. And I think that would be a big relief for the new buyers. So that's a really welcome step.
Right, and reorganization, reassessment provisions, all that set to change over there, which will impact the IBC cases as well. All right, Amrish Shah as well as Ashok Wadhwa, thanks so much for joining us with your initial thoughts on how the budget is set to change the M&A game going forward. Of course, a lot more clarifications and detailing needs to be done going forward as well, and we'll keep you up to speed on that. Thanks so much for joining us on Big Deal. It's a wrap.